Why does behavioral economics prevent optimal portfolio diversification? Imagine trying to build a balanced investment portfolio, but your own mind keeps pulling you in different directions. That's because human psychology plays tricks on us, making it tough to spread investments wisely. Behavioral economics studies how our thoughts and feelings influence financial choices. It shows that our natural biases often stop us from diversifying as much as we should. For example, many investors stick to what they know best. If you're comfortable with domestic stocks, you might ignore international options. This is called familiarity bias. It limits your diversification because you're overexposed to one area, risking more if that sector or region struggles. Then there's confirmation bias. If you believe a certain stock will do well, you tend to seek information that supports that belief. You ignore warning signs or better opportunities elsewhere, leading to concentrated investments. Recent market events also influence how we behave. After a downturn, some investors become overly cautious and shift everything into cash or bonds. This recency bias makes them avoid stocks altogether, reducing diversification when it's most needed. Emotional reactions like fear and greed also play a role. When markets fall, many panic sell, abandoning their diversified plans. They forget that during crises, asset prices often move together, increasing risk. Overconfidence is another common issue. Some investors believe they can pick winning stocks or time the market perfectly. This overestimation leads to concentrated bets rather than spreading out investments. The ostrich effect is when investors ignore bad news altogether. They avoid rebalancing or adjusting their portfolios, which can cause unintended risk concentrations over time. All these biases make it hard for investors to stick to the ideal diversification strategies. Even with good intentions, psychological tendencies can cause portfolios to become overly concentrated. To counteract this, many financial advisors recommend automatic or default diversification plans. These models set a balanced mix of assets based on your risk tolerance and goals, helping you avoid emotional decisions. Behavioral nudges, like gradual reallocation plans, can also help. These gentle prompts make it easier to stay on track without feeling overwhelmed. Education about common biases can improve awareness, so investors recognize their tendencies and make better choices. Regular reviews and rebalancing are essential too. They help keep your portfolio aligned with your original plan, even when emotions run high. In the end, understanding how our minds work is key to building a truly diversified portfolio. Recognizing these psychological barriers allows us to implement strategies that help us stay disciplined. By combining sound investment principles with behavioral insights, investors can better manage risks and aim for long-term financial success.